Welcome participants. My name is Oliver. I'm from the Netherlands. Together with ITC, the International Trade Center in Geneva, and the European Union, we implement the WACOM training and coaching program in the ECOWAS countries. This presentation is about the Cigar box method, designed to make your business decisions easy. This training takes about 90 minutes. It consists of 3 chapters. Chapter 1, Introduction to CB1, duration about 50 minutes. Chapter 2, Make your own CB1, takes about 20 minutes, and we're going to do 3 basic exercises. And Chapter 3, How to analyze CB1, also takes about 20 minutes. It explains how to do your homework for exercises 4 and 5. Now let's get going. Okay, let's start with Chapter 1, Introduction to CB1, Profit Calculations Made Easy. The learning objectives. Well, there are 4. 1. I will explain that there are only 5 profit parameters, not 4, not 6. 2. Very important. I will teach the difference between variable costs and fixed costs. This is crucial in CB1, as you will see. Then I will explain what the difference is between margin and contribution. And 4. I will explain the difference between bookkeeping and the cigar box method. Okay, how to calculate profit. Assume that the egg is a company. It tries to produce a profit and of course avoid losses. Now a question. To make profit, what must go up? In live courses, I frequently hear people say production and sales must go up. That is true, but not fully correct. What if you produce more, but the finished product remains in storage? Or what if sales go up, you send an invoice, but the client doesn't pay? You surely won't get much richer from that. So the correct answer is revenues. Sales that have been paid for, money that comes in. Next question. What has to go down? Of course, costs. That is obvious. So profit is revenues minus costs. I think we all know that. Revenues minus costs. Now let's go one step deeper. Where do revenues come from? Well, actually, revenues is a multiplication. But what multiplied by what? Please think for a second. It is price, yes. Price is the first profit parameter, and it is multiplied by Q, the quantity sold. It's Q with a small q. Capital Q is reserved for the term quality. Now costs. Costs have again 2 components, the sum of something plus something else. So it's VC, that stands for variable costs, the cost of raw materials, processing inputs into outputs, packaging material, cost of delivery like transportation, sales commissions, export documents, and so on, plus FC, that's the fixed costs, is the sum of depreciation, interests you pay to banks, general overheads, and marketing costs. And now what is the 5th parameter? You may wonder, is there another one? Yes, indeed. What largely influences your profit, it eats your profit away, yes, it's tax. Ladies and gentlemen, what influences the amount of tax to be paid? I'm sure that you all know that it's creative bookkeeping and good connections. There you go. Creative bookkeeping and good connections. Profit parameters. As I said, there are only 5 parameters that you need to calculate profit. Do you remember them? The first one is P, price, and it's always expressed per unit. So price per kilogram, per liter, per bag, per loaf of bread, and so on, per unit. The second parameter is VC, variable costs. Again, VC is always expressed per unit. VC per kilogram, per liter, per bottle, per bag, and so on. The third parameter is Q, the quantity sold, and it is expressed in units per period. Tons sold per month, the number of bags sold per year, kilogram of gari sold per day. The fourth parameter is FC, fixed costs. It's always expressed per period, rent per week, salaries per month, marketing costs per quarter. And the fifth parameter, T, for profit tax, it's again expressed per period. Please note that T only refers to profit tax. It is expressed as a percentage of the profit. Other taxes like land tax, road tax, social taxes are included in the fixed costs. Now note that P, VC and Q always refer to the same unit. Otherwise you get strange answers. And also Q, FC and T must refer to the same period. It is not possible to work with a quantity per month while using the fixed cost per year. So again, there are 5 parameters, but only 4 can be influenced by the entrepreneur. In principle, the entrepreneur can, him or herself, decide at what price to sell, which variable and fixed costs to make and how much to sell. But the tax rate cannot be determined by the entrepreneur. For that reason, when we say profit, we actually mean profit before tax. Tax is therefore no longer considered in this training. I advise you to go for fiscal specialists. They can help you with that. Okay, let's look a bit deeper in these 5 parameters. Sorry, 4 parameters. And again, first of all, price. Price is what you receive for the unit you sell. It has a currency, a value, and an Incoterm that determines the terms of delivery. P is dollars, 450, so P is $450 per ton of wheat, FOB Abidjan. And here you go, FOB, free on board, is an Incoterm. FOB means that you as an exporter must pay the cost of transportation from your factory to the port of Abidjan. The buyer pays for the sea freight. So when you, now another point, when you sell an article, you determine the price point. You can see here, the price point is the sales price of your selling unit. So if you do costing, if you do pricing, the first thing you must do is to determine the selling unit. The second profit parameter is VC, the variable costs. Variable costs are all the costs that you have to make for production and delivery. So when you produce more in a certain period, your variable costs in that month will proportionally increase. But your VC per unit remains constant. This is very important to remember. If Q goes up in a period, VC will also go up in that period, but per unit produced, VC remains the same. VC has four components. VC1 is the cost of raw materials and ingredients. VC2 is the cost of processing inputs into outputs. VC3 is the cost of the packaging materials. And VC4 is the cost of delivery, the finished good to the client. Now, to help you remember these VCs, you can see that they follow the flow of production in chronological order. First you buy raw materials, VC1, then you transform them into a final product, VC2, then you package it, VC3, and finally you deliver it, VC4. The real challenge is to obtain correct information. And how this is done and calculated, that's what we're going to explain in detail in week 3 of this training course. Parameter number 3 is FC, the fixed costs. They don't change with production. They are fixed per period. So when you produce more or less in a certain month, your fixed costs will remain the same. They do not fluctuate with Q. I think that is clear. FC also has four components. FC1 is the depreciation of your fixed assets. FC2 is the cost of interest and bank charges. FC3 is the cost of overhead, such as salaries, rent, maintenance, and so on. And finally FC4, that's the cost of marketing, advertisements, market research, and these type of costs. Collection of FC info is relatively easy. You can ask the bookkeeper. Let's do an exercise. Are the following cost items variable or fixed? In a session with live audience, I usually divide the classroom into two groups, boys against girls, and I mark their scores. What do you think? Who usually wins? Well, let's get started. You can write down if the costs are VC or FC. There are 16 cost items. If your score is over 75%, you pass. Otherwise, please redo it. In the next slide, I show you the correct answers. Here we go. Ingredients, variable or fixed? Please note down. Labels, bank charges, machine repair, machine maintenance, sugar transport, depreciation, income tax, diesel for the boiler, electricity in the factory, electricity in the office, temporary labor, management salary, detergents and gloves, rental of a billboard, carton boxes. And here are the answers. Are these costs variable or fixed. Ingredients, that's of course VC, variable. Labels, as packaging material, VC. Bank charges, fixed. Machine repair, variable. Machine maintenance, fixed. Now here's a question. Why is repair variable and maintenance fixed? Do you know that? Let me clarify it with an example. Assume that you have a luxury car. If you drive a lot, you'll probably have repairs to pay. And if you don't drive it, you will have no repairs. But still, you will maintain it. Thus, maintenance is fixed and repair is variable. It fluctuates with use. Sugar transport, that's an ingredient, so that's VC. Depreciation, fixed. Income tax, that is a tricky one. It can either be FC or VC. You must ask yourself, is it income tax on salaries of permanent staff? Then it is fixed. But income tax paid on the salaries of seasonal workers is variable. Diesel for the boiler, VC. Electricity in the factory, VC. Electricity in the office, fixed. Temporary labor, variable. Management salary, fixed. Detergents and gloves, you use that for processing, so that's variable. Billboard rental, fixed. Carton boxes, variable. Obviously, the more you produce, the more carton boxes you use. Now please check your score. If you don't have 75%, kindly redo it. Profit parameter number 4, quantity. Q, the actual quantity sold in a certain period. Usually the period is 1 year. Another important Q is Q cup, the quantity that you can produce at full utilization of your installed capacity. It is usually the capacity of your machines. It is calculated as follows. The quantity your machines can produce per hour multiplied by the number of hours per day that you and your machines can work, multiplied by the number of days per year that you can process, taking into account the harvest season. In this example, we can process 3 tons of mango per hour, multiplied by 22 hours per day, and assuming that we need 2 hours for cleaning and changeover, multiplied by 90 days per year. So our maximum production capacity is 5,940 tons per year. Now the formula for capacity utilization, that is the actual quantity sold divided by the maximum capacity, multiplied by 100%. There's a third Q, break even, very important in cigar box calculations. It is the quantity at which you earn just enough to cover your fixed costs. So it is the point where the profit is 0. The formula is fixed costs divided by the margin per unit sold. In the next slide I will explain what margin is. Margin and contribution. What is margin? Margin is earnings per unit. It is what you earn after producing, delivering and selling one unit. Margin is the price minus all variable costs per unit. The formula for margin is P minus VC. What is contribution? Contribution is earnings per period. It is what you get after selling all units in that period. Contribution is margin per unit multiplied by the units sold. The formula for contribution is P minus VC multiplied by Q. Now assume you sell fertilizer with a margin of 1000 CFA per bag and you sell 500 bags per year. Then the contribution of fertilizer sales equals 1000, that's the margin, multiplied by 500, number of bags sold. That equals 500,000 CFA. Understood? To repeat, margin is what you earn per unit and contribution is what you earn per period selling all units. Margin percentage. What does margin percentage indicate? Do you know that? Try to formulate an answer in your head. Why do we calculate it? Margin percentage indicates risk. In view of environment, suppliers, markets, do I earn enough to mitigate the risks? The formula for margin percentage is easy. It's the margin divided by the price. P minus VC divided by P multiplied by 100%. Here's the question. What is a risky margin? What is a safe margin? Please write down some percentages for your own business. Can you do that for me? What is a risky margin? And what is a safe margin? Usual risk levels in agro-processing, and I have a lot of experience with it, is as follows. A margin below 15% is very risky because even a small reduction in the sales price or an increase in costs will lead to a negative margin. That is why this margin is only acceptable if all parameters are fully under control. For instance, when you are producing under a contract with fixed prices. A margin between 15 and 25% is still considered risky in agro-processing and really only acceptable if the expected production and sales prices fluctuations are in the 5 to 10% range. Between 25 and 35%, that is a normal margin in agro-processing. And a margin between 35 and 45%, we call it robust. 45 to 70% is even very robust. But if a margin is above 70%, that's very unlikely, and I invite you to check your calculations again. As you can see, the cigar box uses a traffic light system. Red is danger, stop. Orange, warning, improve. Green is safe, continue. Please note that these percentages are valid for agro-processing. In other sectors, there are different benchmarks. In farming, for instance, a normal margin ranges from 60 to 80%, simply because the risks are higher. But then again, for tomato production in a greenhouse in the Netherlands, where all production and market parameters are highly controlled, the margins are again similar to the above percentages. Lower risk. A question I get very frequently is quality a profit parameter? One may be tempted to say yes. But the right answer is of course no. It is not one of the 5 parameters. But quality does affect profit indirectly. Quality affects price. Poor quality, lower price. High quality, higher price. Quality affects variable costs. In order to compete on quality, you may want to buy better ingredients, but these are usually more expensive. Quality affects quantity sold. If you have a better quality than your competitor and can offer it at the same price, for sure you will sell larger quantities. Quality also affects fixed costs. If you want to be quality leader in your market segment, you will have to advertise. You will have to do research and development. Hence, your FC will go up. In other words, quality is a choice you make during P1 planning. And this choice affects all the other P's, P2, P3, P4 and P5. Now that you know about the 4 parameters that affect profit before tax, I can ask you, what causes profits? A higher price? Lower variable costs? Well, that depends. If a lower VC results in lower quality, your sales price may go down and you may have gained nothing. What you want is higher margins, P minus VC. And what always helps to increase profit is to sell more, increase Q. So what you want is a higher margin and higher quantity sold. In other words, higher contribution. Now, because fixed costs cannot be controlled in the short term, after all they are fixed, your company objective must be to maximize contribution. Or to put it more precisely, maximize contribution within the limits of your installed capacity. For now, contribution calculation, we can distinguish 4 scenarios. Number 1, low margin multiplied by low quantity. This is a sure recipe for poverty. Unfortunately, this scenario is the reality for many small farmers, processors and street vendors. If you want to escape from this poverty trap, you can. Try scenario number 2, low margin, high quantity. You may call it the Chinese model. Sell at low margins but huge quantities. Or you try scenario number 3, high margin, low quantity. This is the quality model. Expensive stuff that not many can buy. That's also a good option. Now, what you frequently see is that processors choose a combination of number 2 and number 3. For instance, you are a baker. You must sell your daily bread cheaply, with low margin, but you can sell it in high volumes in the morning and evening hours. Now, during daytime, you can use the ovens to bake lovely cakes. You can make better margins with that and still sell in low quantities, but you will use your ovens as much as possible to increase contribution. Number 4, that is a dream scenario. High margin, high quantity. This is the sure road to become a billionaire. Unfortunately, this is almost impossible in agro-processing, unless of course you go drugs. No, this is the scenario for cell phones and other high-tech stuff and internet sales, not for us agro-processors. Bookkeeping versus the cigar box. Why use the cigar box? Well, the reason is simple. Bookkeeping is incomplete and leads to wrong business decisions. Let me show you why. Why use the cigar box method? For starters, let's first look at bookkeeping. In year 1, the company sells 3 products, A, B and C. The sales price and quantity sold in year 1 are given. They add up to a total revenue of 5,000. The variable costs in that period were 4,300, hence a contribution of 700. Deducting fixed costs of 500 leaves a profit of 200. You see that? Take a few seconds to understand the table. In year 2, the company receives more orders for B, 20 units instead of 10, and for product C, 13 units instead of 10. And as you can see, revenues go up, variable costs go up, the fixed costs remain the same, and the profit increases to 250. Again, look at the 2 tables and compare them. So that's an increase in profit of 25%. The bookkeeper suggested to uncork the champagne. My question to you, do you join the bookkeeper in his celebrations? So let's look at the cigar box now. By the way, this is a real case of a fruit processor in Kyrgyzstan in Central Asia. We were requested by ITC to implement the cigar box system there. When we came, the first thing we did was calculate the actual costs of production and delivery for product A, B and C. We found out product A had a VC of 80 and it was sold at 100, hence a margin of 20 per unit. They sold 15 units, so the contribution from A was 20 times 15, that is 300. Product C had a higher margin of 50 per unit, and because they sold 10 units, C contributed 500 to that year's earnings. But now look at B. Its VC was 160. With a sales price of only 150, the margin was minus 10. The more the company sells, the bigger the losses. And they sold 10 units in year 1, resulting of a loss of 100. Now look at year 2. It is nice that the quantity sold of product C went up from 10 to 13, earning 650 for the company. Product B doubled in quantity sold. What the bookkeeper and the owner did not know was that it was a loss-making event. And in the beginning, they refused to accept our calculations. But we proved it to them. They realized that year they lost 200 on product B. When we asked if they could sell at a higher price, the answer was no, we can't. Can you lower VC? And again, the answer was no, we can't. So what was the only conclusion? Stop producing product B. Now look, if they would have cancelled the orders for product B and produced only A and C, their profit would have been 450. An increase of 125% compared to the year before. Now a question, why do you think the order for B increased by 100%? Well, there's a simple answer. Product B was too cheap, and that was why new orders came in fast. In short, the bookkeeping method, and of course not the bookkeeper, calculates only per period. The contributions of A and C were concealing the losses of B. The cigar box method calculates the variable costs per unit, and that is so important. And we teach you how to do that. Let's do a repetition. Here are 8 cost types. Try to learn them by heart. VC1, cost of raw materials and ingredients. VC2, cost of processing, electricity, labor. VC3, cost of packaging material. VC4, cost of delivery, transport, duties. Cost of depreciation is FC1. FC2 is the cost of capital, interest, bank charges. FC3, overhead, salaries, rent, phones. And FC4, advertisements, marketing costs. You may want to repeat this slide for yourself until you know all 8 of them by heart. Let's test your memory and do another exercise. A bit more difficult this time. You do not just specify VC or FC, but whether it's VC1, FC2, etc. Specify these costs. Let's get started. You can write down again if the cost type is VC1, VC3 or whatever. There are 16 cost items and your score should be over 75%. If you don't pass, please redo the exercise. In the next slide, I show the correct answers. Apples. Stickers. Bank commission. Repair on the transformer. Pump maintenance. Transport crates of beer. Depreciation. Pension payment. Furnace oil for the boiler. Electricity for the cooler. Import duties. harvest labor, management perks, detergents and gloves, sales commission, new packaging design. And here are the answers. Apples, raw material, VC1. Stickers, VC3, packaging. Bank commission, FC2. Repair on transformer, VC2. Pump maintenance, FC3. Transport crates of beer, VC4. Depreciation, FC1. Pension payment, FC3. Furnace oil for the boiler, VC2. Electricity for the cooler, VC2. Import duties. The correct answer is that depends. Import duties on what item? If the import duties are on ingredients, then it's VC1. On packaging material, VC3. And if you have to pay import duties in the country to where you export, then it is VC4. And import duties on cars and equipment raise the asset value, thus FC1 depreciation. So always take a step back and ask, for what are these import duties paid? Harvest labor. If you are a processor that picks the harvest from the tree of a farmer, for instance to be sure that you only pick fruits with the right maturity, then harvest labor increases the cost of raw material and it is VC1. But if you are the farmer, then harvest labor is part of the processing costs and it will be VC2. Management perks, FC3. Detergents and gloves, VC2. Sales commission, VC4. New packaging design, FC4. It's part of your marketing costs. It's not packaging material, but the design of the packaging. And one more exercise. Please repeat until you know all the formulas, all the symbols by heart. Indicate if the symbol is per unit or per period. P. P is price per unit. VC, variable costs per unit. Q, quantity sold in units per period. FC stands for fixed costs and they are per period. P minus VC, margin per unit. P minus VC multiplied by Q, contribution per period. P minus VC times Q minus FC, that is profit. That's also per period. You can repeat this as often as you like until you know it by heart. CB1, an overview. Profit calculation for one product for 1 year. Sorry you had to endure me for a long time, but here is finally the cigar box. As you see, there are 2 columns and 6 boxes. In the left column, everything is calculated per unit. In the right column, everything is calculated per period. In this example, the currency is euro, the unit is ton, the period is 1 year. In box 1, the price is calculated. In box 2, the variable costs, followed by the margin and margin percentage. In the next box, you enter the quantity sold. This is then multiplied by the margin to give you the contribution, the earnings per year. Remember, contribution is not the same thing as profit, because the fixed costs still have to be paid. FC is calculated in box 5. Profit is contribution minus fixed costs. You can see that in box 6. And here we also calculate the profit in the way the bookkeeper would do it. Revenues minus total costs. Of course, the result is the same. Further, the cigar box calculates the cost price and the profit per unit, the break-even quantity, and finally, the cigar box helps to calculate capacity and capacity utilization. So, 4 parameters, 24 data fields with assumptions. These define your profit before tax. What the cigar box allows you to do, and it stimulates you, is to get the big picture first. We want you to play with your data, carry out what-if analysis, and be sure of what you present. That is as sure as possible when predicting the future. Remember, ladies and gentlemen, cigar boxing is not bookkeeping. Your assumptions do not have to be 100% correct. It's a planning tool and a very good tool in Excel. Thank you, Bill Gates. So, that was chapter 1. I suggest you take a short break and then we continue with chapter 2. Chapter 2, make your own cigar box. This should be a little bit easy now since you've carefully attended to chapter 1. But first, I will show you conventions and standards that we are using with a cigar box in Excel. And then we are going to do the exercises to show you how to correctly fill in the data in CB1. Cigar box conventions using Excel. Formulas in CB1 are in black. Please do not change them. Assumptions are in the blue cells with blue numbers. I advise you to please write out formulas inside the cells. Here is an example of the cost of energy consumption of an oven. You see the formula in blue. 3.6 multiplied by 2 multiplied by 90 plus 40 times 35 divided by 400. All these blue numbers are assumptions, important ones, but for sure you will forget them. So we strongly advise you to add a note to the cell, like this. The note is a free text cell in which you can explain your numbers. Standards used in the Cigar box. The standards we use during this training and coaching program are as follows. A standardized currency, euro. No naira, no CFA, no cedis, euro. A standard weight, ton. Standard period, 1 year. Measurement system, metric. Decimal symbol, point, 12.50. Thousand separator, comma, 1000, 250.50. Note, we use these standards to help compare across companies, sectors and countries. Exercises on CB1. Fill in the correct cells. Please only fill the blue cells. Now it's your turn. Fill in data and analyze profitability. Exercise 1. Fill in P and Q in the right cells. Exercise 2. Adjust the price of the raw material and cost of labor in the right cells. Exercise 3. Adjust VC2, FC3 and FC4. The data I give you as a sample are from a mango processor. To produce 1 ton of concentrate, 3 tons of raw mango is required, so we have a processing ratio of 3.0. Please download week 1 lecture material. It's called CB1 XLSX. Take 5 minutes to enter the data of exercise 1. Then I give the answers and we continue with exercise 2. So now please go to your company file and open the file LM Week 1 CB1. This is what you will see when you open the sheet CB1 Exercise 1. Read the 11 assumptions and questions on the right, above the drums. Fill assumptions in the correct blue cells of CB1. Answer the questions. The last one, Q11, it's optional, but you will love this tool once you master it. It is goal seek. You can answer that question with goal seek. You go to data, what if analysis, goal seek, and please carefully follow the 3-step dialog box. What is the final answer to Q11? What sales price is needed for 16% profitability? Please pause this recording for about 5 minutes, do the exercises, and then continue with the next slide. Welcome back. Here are the answers to exercise 1. I trust that you have correctly filled in P, VC4 transport costs, and Q. So let's go straight to question 2. sales commission of 5%. How to calculate it? It's 5% of 850. So in cell C7 you write equals 5% times C6. That's the cell where the sales price is, and the answer is 42.5. Question 4. What is the price X works? You read cell C10 and it is 688 per ton. So that's the sales price of 850 minus the sales commission of 42.5 minus transport cost of 120. Question 6. Check the margin and is it acceptable? Well, you read cell 32, you see that the margin is 30.2%. It's green, so it's okay. Number 8. What is capacity utilization? Well, read cell 41, F41. The capacity utilization is 84%. It's green, so it's okay. Q9. What is the contribution? You read cell F32. Contribution equals 1,039,706 euro per year. Question 10. What is the profitability? Is it acceptable? You read cell F9, profitability, it equals 11.2%. That's orange. Risky. I'd like to know at what sales price I can get a profitability of 16%. To answer this, question 11, go to the menu bar of Excel, click Data, What If Analysis, Goal Seek, and follow the 3-step dialog box. If you do that, you find the answer for Q11. You can attain 16% profitability if the price CNF Rotterdam equals 902 euro per ton. That's Excel, that's easy. But dear participants, may I recommend you to try Goal Seek a couple of times with different numbers. Also try Goal Seek for costs and other parameters. You will surely love this tool. Thank you, Bill Gates. Exercise 2. This is what you see when you open the sheet CB1 Exercise 2. Please read the 7 assumptions and questions on the right-hand side of the sheet above the drums. Fill the assumptions in the correct blue cells of CB1 and answer the questions. What is your answer to Q6? Calculate the sales price to attain 16% profitability. Of course, you use Goal Seek. What is your answer to Q7? Can you indeed sell 5,000 units at this higher price? Please pause this recording for about 5-7 minutes and then continue. Welcome back again. Here are the answers to exercise 2. Question 1 was, pay €5 extra for raw mango. So in cell C12, type 95 plus 5. The answer will be the price of raw materials is 100 per ton. Question 2 was, pay €3 extra per labor hour? The answer will be that the cost of labor equals 120 per hour. But how to do this? Check the note in exercise 1, cell C18. It reads, there are 20 workers earning $3 per hour. You want to pay them 3 extra, so in cell C18 you type equals, bracket open, 3 plus 3, bracket close, multiplied by 20. And the answer will be that the cost of production is 120. Question 3. What is VC4? Well, read cell C29 and you see that it is 550 per ton. Question 4 was, what is the margin and is it acceptable? You read cell 32 and the margin is 21.5%. Orange, risky, warning. The increase in the price of raw material and the extra labor cost caused the margin to go down and to be risky. Question 5. Check profitability. Is it acceptable? Well, you read cell F9, profitability is 3.8%, it's red, it's very risky. You will want to do something. So question 6, what sales price do I need to get 16% profitability? You use goal seek and you'll find that for profitability of 16%, the price CNF Rotterdam must be €981 per ton. Question 7. Can you indeed sell 5,000 units at this price? Well, I leave that to you to answer. We've come to exercise 3. And this is what you will see when you open the sheet CB1 exercise 3. There are 8 assumptions and questions on the right hand side. You're requested to fill in the assumptions in the blue cells and answer the question, especially number 7, number 8. Pause this recording again for about 5-7 minutes and then continue. Welcome back again. Here are the answers to exercise 3. Question 1. You incurred 20% higher production costs. So in exercise 1, click cell C19 and you see that the production costs are €80 per hour. You pay 20% more, hence in cell C19 you type equals 80 multiplied by 1.20 and the answer reads €96. Question 2. What is VC? Well, €552 per ton. Question 3. Margin, percentage. What is it and is it acceptable? You see it is orange. Risky, risky. Number 4. FC3, the overhead costs, they go up by 15%. So in exercise 1 you check cell F22 and you read that the overhead is 208,000 per year. So you pay 50% more, so in the cell you type equals 208,000 multiplied by 1.15 and the answer will read 239,200. Q5. Marketing costs have tripled. Again, check exercise 1, cell 5025, and you see that FC4 was 50,000 euro. So in the cell you type 3 times 50,000 and the answer will be 150,000. Question 6 is on profitability. Is it acceptable? Well, definitely it is not. It's loss making, it's purple. Time for action. At what sales price do I need to sell to get 16% profitability? Of course you will use goal seek and you will find out that the CNF price must be 1,030 euro per ton. But hey, that is 21% higher than the original price of 850 per ton. So the obvious next question is, can you sell 5,000 tons at that price? Again, I leave it up to you to answer this question. So that was chapter 2. I suggest you take a short break again and then we continue with chapter 3. We've come to the last chapter of this presentation. Chapter 3. How to analyze CB1. There are 4 sections. Conduct checks. What if analysis. Then there's homework, exercises 4 and 5 that I will explain to you, and how to make proposals for improvement. Section 1. Conduct checks. First, check if the cigar box is complete. Are the cells filled with reasonable assumptions? If you're not sure of one assumption, mark it yellow and continue. Don't try finding fully correct assumptions in the beginning. Aim for 85% accuracy. Once completed, check if there are any red lights or orange lights. But don't change your assumptions at this stage. Instead, first check the VC structure and compare it with a benchmark. Of course, you need to establish benchmarks for your industry in your region and then see if your VC structure is comparable. And if it is significantly different, you may ask yourself, have I made the right assumptions? Probably not. The same for FC. Compare the FC cost structure with the benchmark. Establish this benchmark for your industry in your region and compare it. But you don't have benchmarks maybe, so we provide a solution for you. To help you with the benchmarks, you can use these 3 tables. The first table is for margin percentage, profitability, capacity utilization, and FC over Q, the fixed costs per unit sold. And you will see that in 85% of all cases, these CB1 benchmarks will serve you right. Please use them. The second table, in the bottom left, gives the structure for the variable costs of production, VC1, VC2, VC3. VC4 cannot be benchmarked because delivery costs are hugely different between markets, local, regional, export, and the type of finished good. VC structure is different between B2B and B2C, and that is because of the difference in packaging material costs, VC3. B2B has cheaper packaging, 5 to 20%, and B2C 20 to 45%. That makes it necessary to distinguish between B2B and B2C. The third table gives you a structure for the fixed costs, FC1 up to FC4. Again, a difference must be made between B2B and B2C. And that is because B2C requires higher marketing costs, FC4, advertisement, you name it. Typical B2B FC4 is between 0 and 5%, but for B2C, FC4 can be 15 to 25%. That is the reason that you should differentiate between B2B and B2C. Homework, your own CB1. Let me now explain your homework for week 1. After this lecture has been understood, and of course you can repeat it as many times as you like, open file lecture material week 1 CB1. Go to the sheet CB1 exercise 4. Fill in CB1 for your own business. The CB1 is simplified. No detailed VCs or FCs at this moment. Fill it in, upload answers to your own folder, and we will send you individual feedback. Well, this is the simplified CB1 for your homework. In box 1, you enter assumptions on price and VC4 to calculate the price X works. In box 2, you fill in total VC of production without the details. Then in box 3, there will be the margin and margin percentage. In box 4, you enter the quantity sold and contribution is calculated. In box 5, you do the fixed costs without details, just a ballpark figure how much you think your fixed costs are in a certain year. And the profit will be calculated and the profitability. The next thing you do is to fill in the capacity, and you will see your capacity utilization. And with these few details, dear participants, you will learn a lot about your business. It's not too difficult, but use the assumptions that you know for your own company. And then, of course, upload the file to your drive. So here are the detailed instructions belonging to exercise 4, your first homework. This is what you will see when you open the sheet CB1 exercise 4. Please read the 18 assumptions and questions. Fill the assumptions in the appropriate cells in CB1. Answer all questions. When you're done, upload this Excel file to your company folder, subfolder, homework, week 1 with the appropriate file name. We've come to section 2, what if analysis. In exercise 5, we are going to do what if analysis for 3 scenarios. 5.1, a basic scenario with the assumptions as you know them. 5.2, a best case scenario with positive assumptions. And 5.3, a worst case scenario with negative assumptions. Will your company still be profitable? In exercise 5.1, you completed the basic scenario with the assumptions as you know them. There are 7 instructions in sheet exercise 5.1. Evaluate. Are there any red lights, or orange for that matter? Is the VC structure in line with the benchmarks that I've given you before? If not, can you explain why not? Then do a what-if analysis for the effect on profit. Test sensitivity of changes in P, VC, Q, FC with your own assumptions. And here are the detailed instructions for 5.1. You see there are 7. Copy the data from exercise 4 into this CB1. So that's the data on price, quantity and capacity. Add variable cost details for VC1, VC2 and VC3. And then please check if the VC of production is more or less equal to the VC in exercise 4. The same for the fixed cost. Add the details for FC1 up to FC4 and check if the sum of these 4 FCs is more or less the same as the FC you gave in exercise 4. Of course, I don't know what profitability comes out of your assumptions, but please do the exercise, calculate which price you need to attain 16% profitability. Save the CB to your own folder and continue with the next exercise. Section 3, Proposals for Improvement. In this section, we prepare a best case scenario. That's in sheet 5.2. The instructions are simple. Copy the data from 5.1 to 5.2 and write down the improvements you think you can make and how realistic they are. Fill in the new assumptions in the best case scenario and compare it with the basic scenario. Is this realistic? This is the starting table for exercise 5.2. You see an empty cigar box and on the right top side you see the instructions. On the table below that there are automatic links with the basic scenario and this scenario so that you can compare the most important features of both cigar boxes. Well, things can also go wrong. So, based on the base scenario, prepare a worst case scenario in sheet 5.3. This is the beginning table 5.3 worst case scenario, and what you see is on the table on the right a third column is coming up where you can compare the most important benchmarks and cost structure for the basic scenario on the left, the best case scenario in the middle and the worst case scenario on the right. This helps you to understand your business even better. You report these scenarios, and this is the summary table I talked about in the previous slide but now enlarged. You see you can compare the prices, VC, VC1, VC2, VC3, margin percentage, FC over Q, the quantity and the capacity utilization, profit and profitability for the 3 scenarios. Upload this file to your company folder with any comment that you have. We will then answer your questions individually. We've come to the end of this presentation. I hope you found it useful. If so, give us a thumb up. Merci. Thank you. Obrigado. Hoping to hear from you.